Well, good afternoon, investors. Welcome to our October 24th, 2023 edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by my very dear colleague who's returning from the Northern Leaf Changing Tour in Michigan, Ken Kavula.
Yes, Mark, thank you. We smacked it right on the nose this time. The colors were spectacular up north the end of last week. Just absolutely the best color I've seen probably in 20 years. Just wonderful, beautiful.
Yeah, I think this year we benefited from the rains not knocking the leaves down. You know, they let them stay up for a while. So
We had 2 days of beautiful sunshine, and that makes the maples especially just look like they're fluorescent. And anybody that's never been up in the Traverse City area or in the Petoskey area, I would put a big plus on the Sky Bridge at Boyne Mountain. Go and see it and walk across it. It's quite an experience, I'll tell you. And this time with all the colors below you and the bridge itself, just absolutely one of the best experiences that I've had outdoors in the last 15, 20 years.
that's really cool. I'm glad you were able to do that. All right, we do have like 60 or 70 degrees here in southeastern Michigan, but we generally turn to Houston and the southeastern coast of Florida to get warmed up. And again, we have Kim Butcher joining us in the back room. Welcome back, Kim.
Hello, everybody.
Kim was the one that was talking about all of the yachts coming in, and she's Kim, it's your job to get us a couple of those yachts to come down and have a good time on.
We just want her to throw a party on a big one, that's all.
Yep.
Well, let's just keep picking great stocks.
And from Houston, and he's advising us that his air conditioner did shut off overnight, Matt Spielman.
Yeah, 84 and breezy.
Not bad.
No color though. It gets brown. That's the only color you get. It is
Matt,
hard to beat.
I'll bring you back to
many a fall in Traverse City.
I'll bring you back to Michigan, Matt. It's 70 today, and they're calling for snow on Halloween. Okay.
I see. There. My mom is actually coming down tomorrow, and she's in Minnesota. She drove up to Minneapolis to get ahead of that coming. So I'm like, oh.
Well, a friend of mine reminded me that during an October baseball game at Tiger Stadium not too many years ago, it did snow on a baseball game, so it can happen.
I've been to I took some suppliers were in town, and we went to a late fall game in Comerica Park, and the alcoholic stand changed from margaritas to spiked hot chocolate. They have that covered.
Oh yeah.
Our friend Len is on Grosse Seal down in the southern end of the county on the Detroit River, and he says it's 68. It's not too often that we're actually warmer than southern Michigan, but we're at 72, Len, today. So I'm very pleased to get one last day of summer before the temperatures turn the other way.
Well, Len certainly has a great view down there too.
Yeah.
All right, so moving on, we're going to cover just a few things today. I was reminded that we should give a reminder about the digest capability manifest, so we'll do that. We're obviously going to dive into our best small companies. Einhorn is back on top again at Greenlight Capital, and his erratic performance over the years is something to marvel at, but he's back on top. Tom Lee was recently on with Josh Brown at the Compound. And I've followed Tom since the late or mid 1990s, and he's one of the better down-to-earth analysts out there. So we're going to spend a few moments talking about some of the things he had to say recently and just point to a couple of things. And then we'll close with just a moment of curiosity about the Better Investing, NAIC, Most Active list and some of the companies that are on it, and just ask a couple questions kind of as a teaser probably for next week. So with that, Ken, anything you want to add?
Well, I'll tell you, Mark, whenever I see Tom Lee on TV, he's, in my opinion at least, he gives well-reasoned arguments. He speaks in simple English. He's easy to understand, and I think he's extremely logical. He's a joy to listen to, and when he and Josh Brown start talking, it's a conversation that you should stop and listen to. It really is.
Yeah, he's one of the top-ranked analysts going all the way back to 1998 by institutional investors. So he's got quite a track record, and we'll actually spend a moment with that also. All right, let's go ahead and get our standard disclaimer out of the way. But first, we have to remind everybody that Portillo's is not a sponsor of this episode or session, but they should be. And Ken, in the latest news that I thought would be extremely important to you and Natalie, they have announced that Portillo's will be opening a second store in Michigan. And
I know where it is, Mark. My sister announced it to me last week on vacation.
Oh, your sister is a very wise lady.
It's going to be in Livonia, very close to where she lives. And so I will be able to go try out this wonder of all wonders of hot dogs.
Oh, field research. You just can't beat great field research. So, there.
I thought you were going to say field research of pumpkin pie shake.
Well, yeah, that's just the reminder. We let that stay there because everybody should be aware that that's not going to last forever. And pumpkin pie shakes are there at Portillo's now. All right, onward. All right, here's your reminder that no investment recommendation is intended. This is all about education. Everything that we do here is very heavy on demonstration of the principles, methods, techniques, analysis, approaches that we have as a result of our participation in the modern investment club movement. So you'll hear our opinions and our interpretations of some of that stuff. Please do your own homework and before you make any investment decision of your own. If we own something, we'll try to remember to disclose that. Again, we believe that you are all, since you're, by virtue of the fact that you're here, you're above average. And second of all, you can make your own decisions. A week from today, plus 1 day, I think that's right, Ken, we're going to actually have our October roundtable on November 1st. We didn't want to compete with the trick-or-treating on the evening of Halloween. I think I'm getting that right. So we're actually going to convene on November 1st for the roundtable.
And we've moved the time back to 8 o'clock, Mark, so we don't keep people up real late, but we'd like to introduce our best small companies list. So at 8 p.m. on November 1st, the roundtable will be convening. If you haven't got a chance to register yet, if you go to the Better Investing website and look for the Mid-Michigan chapter, you can register there. Or if you go to Manifest Investing, Mark has a registration link in the Events tab on Manifest Investing as well.
Absolutely. And if you have any questions about any of that, or if you'd like copies of slides, or if you have suggestions for future topics, our 2 email addresses are there on the screen also. Okay, let's get underway. This is kind of a mailbag thing. I had received a few inquiries about our email support with respect to features. We publish a lot of stuff on the Manifest forum. In fact, there are quite a few people out there that don't frequent the forum probably as much as they should, and they actually receive many of the forum posts in their morning emails. And if you go to your Manifest Investing account, click in through Help, go into your Edit Profile. As you can see from me on the left there, you can actually opt in. We don't automatically put you in any of these. You have to opt in and ask for them. That way you can shut them off if you find it to be too much mail. But you can see I'm basically opted into a number of the different categories. And this is just a snippet of an email received. You can see that it actually came to me early this morning. And anytime we do one of those type of companies on the forum, you can actually receive that. And again, you can avoid going to the forum this way, but it's one of the downsides to it, because oftentimes there's follow-up discussions on there that get spread out over days or whatever, and you can treat them all the same. Anything you want to add to this, Ken?
No, I get from three of them, Mark, and I find them useful to kind of keep up to date. I don't have the time a lot of times to go into the forum and go thread by thread by thread, but with this profile like this, with this option, I can get things I'm interested in, and then if I want to respond to it, I can.
Mm-hmm. Okay. Well, moving on, here is our weekly look at the value line arithmetic average. The green price bars are quarterly, going all the way back almost 25 years now to the turn of the century, and the green price bars are basically represent the stock market as we see it through the eyes of all of the above investing. The companies in the value line standard edition really do represent small, medium, and large companies, and so you can see those quarterly zigs and zags. The thing that we've been pointing out for quite some time, we probably will for quite some time, is things did get a little bit frothy there for a while. I like to compare the size of that outperformance to this little notch over here of that period of dramatic underperformance where the green bars stayed below the blue line for quite some time. The one on the left is that 2008-2009 moment is regarded as one of the worst periods in stock market history. And I like this is actually a little bit stunning. The area of this white space back in 2008-2009 actually doesn't even keep up with what we just went through. And that's pretty wild stuff. So right now we've come down the last 6 or 8 weeks. The stock prices have lagged a little bit. Some of our portfolios have suffered a fair amount. And the result of that is that return forecasts have crept back up into the low teens. And I suspect that many of us are finding a few more things on sale. And based on all the stuff that I'm seeing, probably not a bad time to do some pretty good shopping. Your thoughts, Ken?
Absolutely, Mark. I'm finding also that some of my really high quality small stocks are beginning to show signs of life. The small stock indexes as a whole are still kind of lagging everything, but some of the really high quality small ones are beginning to show 3, 4, 5% increases on a fairly regular basis. Coming back to where the market is. And that's what we've always been saying, that if you expect out of your small stocks the same kind of performance that you expect out of your medium and large, and if you stick to small stocks with that kind of history and that kind of characteristic, then you have a chance of really making some good money with small stocks.
Yeah, I've been feeling that. And getting a little bit impatient, but still, I think a lot of the smaller companies are going on sale, and let's see what happens. All right, just here's a couple nuggets from the internet. This actually comes by virtue of Grit Capital and Bloomberg. I'm going to declare it a little bit of a chart crime, not an off the chart crime, but we talked a little bit about this last week. We are actually in a period that is a little bit unexperienced, unprecedented, at least for me as an investor, and that covers several decades. But the 10-year yields have actually topped above 5. 5 seems to be a bit of a magic number for many of the rhinos, the institutional investors out there, and there's a little bit of drift just due to that. But I think this chart itself is a little bit misleading, kind of just to make the point that it has gone back to the 2007, 2008 levels. But I'll switch to the next one, and then Ken, you can tell me if I'm crazy.
Exactly, Mark. I think that the chart's a great example of not telling the whole story. This is the chart that I would hope everybody would take a look at. This is what, 30 years about? Yeah.
It's actually pretty close to 40 years now.
40 years.
40 years.
40 years. Yeah.
Yeah, so that chart is basically showing you from here and to the right. So it's basically ignoring the fact that the entire period before that previous chart is above that level. So I don't think you can ignore that when you're talking about this subject. And you can see that it has been quite frothy. The other thing that I notice here that I left the relative strength index, again, looking back 12 months at a time on here, because what this basically shows is when there have been, I don't know what they call it, fits and starts or surges, or however you want to think of it. There's only been a couple of them, over the last several decades, but we just had a fairly good size surge to the downside. And then this surge up here is what is so noticeable on our mortgage statements and everything else. And the fact that that went up so much so fast is captured here in what I think is a fairly representative perspective. And I was a little bit surprised, Ken, to see that it's really only the second time we've had that type of a spurt to the upside like that, and it's fairly major as measured by over 40 years here.
I would point to also the one, Mark, right before the turn of the century, in the 98, 99, 2000 time period, as being something that was quite dramatic as far as I was concerned. I was investing at that point there, and I think that upward movement right there, which culminated in the dot-com bust, I think that's a moment that I will always remember in my years of being an investor.
Yeah, and of course, this one here is the response to the financial crisis, and we basically headed in that direction and didn't look back. It will be interesting to see where this all goes. The economy is a really tough read right now, and
I spent the long weekend with a gentleman who has a much shorter time frame in investing and believes in investing in highly cyclical companies to make money. He's made a lot of money in the stock market, so I don't fault him for having a completely different philosophy. But he was extremely concerned about interest rates because, quote, they were never as high as they are now. And I was able to pull this chart up on my computer and challenge him to tell me what an average interest rate was. And after looking at this chart, I think he had a little bit different feeling about where interest rates are and where they might be headed. I'd be willing to call 4.5 to 5.5 average on this chart rather than high.
it is. And I actually, my theory, and it's just a theory, so we've talked about the control range between 2 to 3% for inflation. I wouldn't be surprised to see interest rates return to somewhere in that realm, and maybe 4.5% is the upper side of that realm, Ken.
Yeah, yeah.
Not completely. It's not irrational to think that, but this does give a little bit better perspective, and we do encourage the long-term perspective here. Okay, one last, and this is just another tiny bit of chart crime from my perspective, because you're hearing this type of a narrative all over the place. Basically, the American consumer going completely ballistic from a shopping or retail standpoint, and you can see that however they do this calculation, it certainly makes it look pretty volatile, pretty vicious. But when you stack it up, and I basically just took 10 of the largest retailers, household names, and added them all up, that you can see here on the right. And again, thinking long-term perspective and maybe just, across the board perspective, every one of those dots hits that line. You can see if you squint, you can actually see the bubble heading down below the line in 2019. You can see it slightly above in 21, 22. But I don't know. A little squinting is good, but I don't know. Just another one of those things that kind of bugs me. I don't think that anything is terribly unusual when you put it in a really long-term perspective.
I agree, Mark. We've had quite a bit of conversation in two of my clubs about retailers. We own Five Below, and we own Dollar General, and we own Costco in the various clubs that I belong to. And all three of them have been, after having the kind of problems you might associate with the pandemic, all of them, even Dollar General, have come out of the doldrums and have been performing as if nothing is wrong with the consumer. Dollar General changed CEOs and shot up 20%. That's not, in my mind at least, that's not a normal reaction to a CEO change, but it still shot up 20%, and I'll take it. You know, the same thing with Five Below. It's just been in the last maybe 9 months, it's just been a continual outperformer until it's dropped down to the bottom of my par list in my own portfolio, rather than sitting up near the top where it was an attractive buy for a while during and right after the pandemic.
Yeah, so I guess the subtitle to this chart, from my perspective, could be "What's a couple of $1 trillion amongst friends?" All right, moving on. And here is that reference that we made earlier to Tom Lee. And I'm not going to declare this to be a chart crime because it's way beyond my pay grade. But Tom is a good one. And as Ken was saying earlier, pretty down-to-earth discussions. He is the head of research at Fundstrat. He appears on CNBC. Ken is a groupie. But one of the things that he pointed out in the session with Josh Brown, I'll put a link to it in the notes and on the pages at Manifest. But his whole summary of the situation we're in right now, you know, we've been kind of languishing for a couple of months. And I'm paraphrasing here, but he specifically brought up the regional banks. And that's where I figured Ken would have taped it and transcribed it and sent it off to all of us. But he brought up the regional banks. He says, just think about it. What haven't they been challenged with? And they're actually holding up fairly well, you know, looking at them collectively. There's obviously a couple of companies that, you know, went too far off the deep end. But when you take it from regional banks to many of the companies in the economy in general, they have had a lot of stuff thrown at them. Turbulence in all kinds of things. And he brought up the UAW strike going on right now. But he basically said, you know, find these good companies that are out there. Some of the regional banks are great companies, and be willing to be patient for a long time. And,
he made the point when talking with not with talking with Josh Brown, but talking with another analyst who is not my particular favorite, and therefore I won't name her. But he made the point that the regional banks have also had to put up with a daily tongue lashing from almost every analyst that sits on this network. And he was talking about CNBC. You know, almost every one of them doesn't pass by an opportunity to badmouth the regional banking industry. So it's hard to get traction until you actually do get traction, and then just like sand on ice, you can suddenly take off once your tires bite in, you know?
Okay, and the chart on the right, I love charts. I'm a chart guy, but wow, this one is stacked with stuff. The big story here is that technology as a sector, the companies that are in the S&P 500 and then the technology sector have been overpowering things. That's why we talk about the Magnificent Seven. And he doesn't see it coming to an end anytime soon. And anytime a person like Tom Lee is giving us a 2015 through 2047 perspective, I think it has some merit. And he's gone all the way back to before the Great Depression and talked about the cycles that come with labor shortages, and just basically makes the case that technology is not done yet. And I think there's 6 or 7 predominant sectors in all of our portfolios, and technology is one of them. That doesn't need to change anytime soon.
Do you think, Mark, that as we evolve, that our data sources are going to begin to define technology in different ways so that we can break this sector down into maybe 2 or 3 or even 4 pieces?
It's possible that could happen. I mean, we saw a form of that happen with the reclassification of companies like Amazon.
Exactly.
So I mean,
Exactly.
so again, we don't want to get too hung up on the labels either, but that's just simply the way it is. Rick Barry is there just to remind me to talk about granny free throws, and we will in a minute here. And here's the look at the current composition. This is on the S&P 500. I think this is probably based on the Vanguard S&P 500 fund, and you can see the technology. It is the largest sector, 5% of assets running in the high 20s. And he's basically saying he wouldn't be surprised to see that. At least the companies that are currently defined as that sector actually accounting for 50% in the distant future. So that's pretty wild, really. All right. And here's the Granny's free throw came from, they actually put out some publication, a newsletter, which talks about looking for grannies. And Granny is a tribute to Rick Barry. He used to shoot his free throws underhanded. Those of you that may remember this, Ken, I'm going back and I'm actually talking about somebody from years ago. So are you going to you're biting your tongue, aren't you?
Well, I remember girls' rules basketball where the girls had to stay on one side of the court. And I remember being taught in 5th grade that the most accurate free throw you could throw was underhanded. So it's all coming back to me in
Okay.
bits and pieces, Mark. All right.
All right. So I've shot a few free throws Granny style in my career. And by the way, he made like 95% of his free throws, so it's pretty hard to knock it. He looked kind of silly doing it, but it sure did work. Anyhow, they put out this collection of companies in their newsletter. He actually named them during the compound broadcast with Josh Brown and Michael Batnick. And these were the 5 companies they had added. And again, they're looking for companies, and I think this is why we kind of have an affinity for him, Ken. They talk in many of the same flavors and tones about investing as we do. He basically talked about quality companies that you wouldn't shrug at all or you have high confidence in. Notice the overall growth forecast of the collection of 5. This is just lining up with some of our favorite aspects of investing. And the 5 companies are right there for you. If you want, we'll watch and see how well these do. That particular newsletter feature, he basically made the statement that it has run 5 to 10 percentage points above the market for as long as they've been doing it. And we know how special that type of achievement is. So kind of interesting to watch how these do.
What I like, Mark, is this guy's take on earnings. I listened to him share a conversation where he was asked about a 3 companies that had no earnings and didn't have any prospects of having earnings anytime soon. And he made the statement, he chuckled first of all, and then he made the statement, he says, trying to be an analyst for a company that has no earnings is more akin to wishing on a star than anything else. So
Cuts me deep. Oh, well. Good stuff. Tom Lee, recommend it. And like I said, I'll put the compound link also on there. All right, shifting gears and going back to the groundhog. I tried really hard to get on the list this week. I'm up pretty close to 40 as of the time of this session, but as of this morning, I believe I was 49th. So I didn't want to put 50 names on here. Times are rough. I mean,
I noticed that Kim and I are not 59th, Mark, or 49th.
Yeah, I keep noticing, and
just want
Kim
to say
and
that.
I mean, I put Ardelyx on here either to jinx us or give us good luck, one or the other.
Well, I'm hoping I have 2 catalysts to bump me up there by the end of the month.
In the catalyst,
we have
Ardelyx,
quite a bit of time yet, Kim. We have until February 2nd, remember, on this contest. So,
a long time ago.
Oh, then I'm grinning.
Yeah.
Well, I think VMware is going to really be a happy thing for me.
Oh yeah, you've got that coming for sure.
Oh yeah,
it's a sure thing. And Ardelyx has been, for those of you that don't follow Ardelyx, it is a non-core speculation that several of us have indulged in. Many of us for the groundhog also. And the FDA did approve their kidney treatment just last week. The stock price has not behaved well since then, and
I, the master under phrase of all times.
Well, I think we're getting just a little beaten up by the rhinos, but you know, us small cap investors can really beat the rhinos.
well, we just have to be patient and let it work its course. I think as their operations unfold here over the next couple of months, it'll be rewarding, I believe.
Mark, Herb has his hand on the air, and he probably wants us to note that his Cool Kids Club is in 4th place and he's in 7th place. Am I right, Herb? Is that what you want to say?
Yes, and I noticed that my Cherry Capital is in 32nd place, so I got 3 different entries way up there in top.
But you're not bragging; you're just informing us, right, Herb?
You know what? I wish my personal investments were as good as what my picks were.
Thanks a lot, Herb.
Just point to the scoreboard. Point to the scoreboard. Speaking of the scoreboard, we do have a relatively low number of participants beating the general stock market again this year. And oh my, that average groundhog return was about -4 last week. It's at -10 this week. And the Wilshire has also taken a bit of a hit. And the value line arithmetic average, I do not recall the last time it was so much lower than the Wilshire 5000. So that just, again, screams of the type of opportunity that Ken was talking about for small and medium-sized companies. And we are grateful that the monkey is languishing. All right.
Mark, I just think it's time to take to heart, though, George Nicholson's warning that during markets where the kind of stock you're looking at is undervalued, that's the least opportune moment to go after something risky. Move to high quality, move to more safety, move to things that look a little bit stodgy but look very, very resilient and look like they're going to be able to repeat and then repeat again what they've done in the past.
You sound just like Tom Lee, Ken. And
okay.
And for the audience, he's actually warming you all up for when he's going to hold me to higher quality aspirations for the best small companies. All right, moving on. And we did get a little frisky last year, and we're paying a price. And this just falls into the category of being a little bit unfortunate. We do have a 7 out of 8 year winning track record. Unfortunately, the last 2, because I do not believe, although that bunny on the left is praying and the ones on the right are warm and cozy, I don't think anything's going to save us at this point, Ken. We've got 7 days to go, basically, plus a few. And thank goodness for Technoglass and Yeti. But, the scale probably doesn't do it justice, but we have actually fallen back behind the Russell 2000 Growth ETF. And by the way, when the rocket started flying over in Israel, the InMode went from near the top of this list to near the bottom. Just a reminder of how powerful those moves can be. Anything else we should add here, Ken?
No, except for the fact, Mark, that there are some really excellent high quality companies on this list, and I wouldn't be surprised if there's some repeats from this list for our list next year.
Yeah, and I'm trying to figure out how to keep emotions in check. And a few years ago, we wrote about a company that had been just performed dismally for 3 years and had inflicted some damage on our results, although our overall results were good. And then we took it off the list, and if we had left it on the list, it would have been up like 300% the next year. So you always want to keep that longer term situation in focus, but at the same time, stubborn can be a condition which is hard to deal with on the emotion side.
Well, and in a short-term contest, stubborn can also be a disaster move. So this is short term. It's for fun, but it's not what either one of us do. I think for actually investing, we're looking a little bit longer term when we're actually buying things.
Yeah, I'll just double down on that. I can't stand it when a clock runs out on me, so that's why I do very little with options. And everything I buy is basically long term. And for those of you out there wondering, yes, I do still hold my shares of Western Alliance. All right.
As do I.
All right, Ken, we kind of kick things off a little bit. Just repeat a little bit from last week. Again, our contest every year, I would call it a demonstration, runs from Halloween to Halloween. And so we're coming down and closing out this year's contest, and then we'll be selecting the entrants for next year. And this is just kind of a short list. We're looking for companies that have a decent growth rate, double digits, hopefully greater than 12% if we can find it. And you heard him warming me up for this one. Excellent quality is a good idea. And the combination of an excellent quality track record in combination with a superior return forecast keeps you out of trouble more often than not. So it's just something to keep in mind. And consistency is important. It'd be nice if they were a little oversold as we go into them also. What would you like to add, Ken? What's your...
Well, I don't want to add anything because we've already made the point that we want to have earnings, and that's been made by the first 4 points, I think. But that last one right there, I at least want to be a little bit looser on my definition of what's low. And if I have superior return forecasts, I'm not too concerned if the RSI is in the 40s or 50s or even 60s.
Mm-hmm.
So I'm not going to force us, or at least my thinking, I'm not going to force it into a narrow field of looking for RSIs less than 30 or less than 20. I think that superior return forecast is where I'm going to put a lot of my time, along with this idea of excellent quality.
Yeah, and we kind of mentioned that low relative strength index along with the 52-week low is kind of a tie-breaking concept last week.
Absolutely.
Or a secondary parameter, if you want to think of it that way.
I think that consistent growth expectations also needs to take into account this year, especially. I think that we're going to be able to identify some smaller companies that are perhaps beaten down for reasons that have nothing to do with the company itself or the product they make. And I think we should be willing to consider a beaten down company that has a lot of room to make up just to get back to where it, quote, should be, unquote. And let's talk about some of these fallen angels and see why they fell. And can we come up with a good thesis on where they're going to be at the end of the year?
Sounds good. So we've already hit a couple of key areas. We're going to spend a little bit of time with the actively managed mutual funds that are in the realm of small companies. That's what we'll look at in a little bit more detail here today. And then we'll round things out with a couple of our other favorite sources next week. Here is the fund manifest, focusing in on companies that tend to feature smaller, faster growing companies in their portfolios. They are ranked by the best performance on the far right, those relative returns. And this group of funds, by the way, would, if you went back 2 years, you would find that virtually all of them are in the green with respect to relative return. Case in point is number 20 down there, Brown Small Company. This poor performance over the last couple of years is rather unique to them in their long-term history. And it just is another nudge saying, if you can step away from the emotion a little bit, there's probably some really good ideas on this page and as a place to discover small companies to explore.
Yeah, for folks that are new to this kind of list too, Mark, we should make the point again that small cap does not necessarily mean small company. So some of these, even though it says small cap, some of these, when we actually look at the holdings, they do have some smaller companies in, but a lot of times they have companies that we would kind of traditionally call medium size or even large companies.
Yeah, and just a couple of things to make a point about. Notice the growth numbers here. And to Ken's point, this small cap here, although this is a great fund, those are not necessarily all small companies. When you see 7% there, down here you can see Wasatch Micro. That's not a micro growth rate. So just some interesting stuff going on there. But again, this is a field of companies that we can kind of explore for opportunities to study. Notice that the top of this list, and Ken, I think this kind of makes your point. Look at the 70s, 80s, and 90s up here at the top of this performance list and contrast that with the numbers you see down here.
Yep.
And
And
that's
the
over
only
a long time.
exception, Mark, seems to go with that microcap, that Oberweis microcap that has growth rates just under 20%. And to achieve those growth rates, they're looking at lower quality companies. Let's stick with the quality and let's see where that takes us. Susan has her hand in the air. Mark, I'm going to unmute her. Susan, you'll have to unmute yourself if you want to speak to us. Susan Zalusky or Zaluski, you want to unmute if you want to speak? I'm going to assume that's an inadvertent hand then, and continue, Mark.
Okay, and I will finish out this hole in these here is simply because there are many uncovered holdings in Davenport small cap focus, and we'll take a closer look to see if we can do coverage. Did you have something, Ken?
Our friend in Maryland wants a point of clarification. He wants to know, is a 27.7 quality rating good or bad? He wants to know.
He's probably referring to that one.
Oh, all right.
He's kind of stuck in a trench, Ken. So you just got to
I know
grit your teeth and deal with it.
It's a repeating cycle here. Okay.
Uh-huh. Every once in a while, you just got to let your hair down and get in the convertible and step on the gas, and hope for the best. I don't know. Anyhow, so that is it. So one of the points I wanted to make, and I think this shows it fairly well. If you go back and look at the companies is arranged by their market cap. So, there's a little bit of drift here, but by market cap, you can see that going back to the early 1990s, the best performing group is actually the medium-sized companies as represented by the S&P 400. That's the orange line up at the top. The small, which often will be the leader of something like this, depending on what time frame you choose, is in second place here, as denoted by that light blue line. And then down at the bottom, you do have, after that flat lost decade period in here, long-term effect of that period of time has been that the S&P 500 large companies are actually a fair amount lower than the other two groups. And one of the things I wanted to point, and so that's why we do shop for small, medium, and large, and we do like to have as much as 50% of our portfolios in the mid-sized companies and another 25 in the small, and have that augmented by and filled out with some excellent large companies also.
Have another hand in the air, Mark. Susan Ollinger. Susan, if you'll unmute yourself, you can speak. Susan Ollinger or Ollinger, you're self-muted. I can't unmute you. Okay, and again, I'm going to assume that's an inadvertent hand. Mark, I'd love to see these graphs, and I know it's probably very difficult to do, so I'm not asking anybody to do it, but I'd love to see these graphs with the companies that have no earnings deleted from the indexes. I really do think that the blue line and the orange line would switch places if that were to happen.
Interesting thought. I could probably engineer that, Ken, so let me think about that. anyhow, the last several years has been a little bit different. And what we've seen happen here with the Magnificent Seven and some of the stuff that's going on, here are the last couple of years, the S&P 500 has actually flipped that previous page. And I point to a couple of points in time back towards the end of 2019 when they were all kind of running together. And then again, as we kind of came out of the pandemic, they were kind of together again. But you can see that the large companies have significantly outperformed over the last couple of years versus the small and medium-sized companies. So this is just a kind of a look. I'm not sure if I could point to any particular trigger.
Is it, Mark, is it pointing to the ascendancy of what they're calling the Magnificent Seven? The fact that they've become companies that everybody feels they have to have in their portfolio?
I think that's got to be a contributing factor, without a doubt. They definitely have pushed things much higher on that purple line. So anyhow, that's what's different. But again, it also points out, as we've been talking about over the last several weeks, if not months now, there's probably some interesting long-term opportunities in these smaller companies. It's just a matter of finding them. All right, here's a quick look at, as I went through and discovered companies that were not covered by us at Manifest amongst those small company funds we were just talking about a few minutes ago. There's quite a few companies on here that jumped off the page, and we will be taking a closer look at. I would draw the audience's attention. I don't know if you've had a chance to study this list at all, Ken.
No, it's on my list it's on my to-do list. However, I like the fact that you've given us this. Yeah.
And the company should actually be in coverage within the next day or so. So you could build a dashboard. Maybe we'll demonstrate that here next week. There's a lot of companies that you were just moaning about, Ken, that probably do not have a whole lot of earnings. I did have to leave a couple of off that didn't have sales. So there's a few of those on here. I would point out any company without an asterisk is in the Value Line Standard Edition. So we caught up on a bunch of companies here. Again, some of my favorite sources have been Janus Henderson. That's a decent company to look at up here. Core and Main. The
Mark,
Lantheus. Go ahead, Kim.
I can tell you that Stanley Druckerman has backed up the truck on that fourth one there. I can't pronounce.
Coupang?
Yeah.
I'm pretty sure that's how you say it.
Yeah. He backed up the truck there.
And if that gives me a reminder, maybe we'll take a look at one of the sources for checking that out also and doing some cross-referencing. And that's also a favorite of the gang over at Motley Fool, so might be worth a little bit of a deeper dive. I'm pretty sure that's a South Korean internet content company.
I believe you're right.
Okay, kind of an Amazon of South Korea.
Mark, on the I'm forgetting the name of it, on our communication program that we're back and forth on, I gave you two more ideas off of the small company screen from Better Investing.
Mm-hmm.
ESEA and IGIC. They both look pretty good on a chart.
Yeah, I'll make sure I add those also so we can get them into the screening content. The other one I found kind of interesting was this Transmedic. Again, it's covered in the standard edition, and that has to do with human organ transplant or transport and care and all that would be associated with that. So that's kind of an interesting topic also. Okay, so that's some of them there. So Ken, here's the list we kind of kicked off last week, and we'll just revisit it again here today. We kicked out a few companies on the virtue of just having too high of an annual sales count, and put them down into a purgatory for now. And I don't know, you and I have not had the debate yet. We only did 12 companies this year. We had done 20 in the past. Maybe we go to 16. I don't know. The only way that I'm going to sneak a company like Portillo's in there is if we go to 20. So
I will tell you, Mark, that number 16 was, in my mind, a great choice for the list until it went up 20% today.
So yeah, you can see it on here.
It just completely
I-
blew earnings out of the water. One of my clubs owns MedPace, and it just blew its earnings away just big time. And the company we've always felt was poised for a big move, and it just it moved today big time.
Yeah, well, that creates an issue for us. Did I also see, and I might be mixing them up with somebody else, are they an acquisition target also?
No, I don't think so. Not from
Okay.
what I read. Um,
Okay.
I still like InMode and Monolithic Power. I like them a lot, and I like Descartes down near the bottom of that list, even though it doesn't have as strong a sales number as a lot of them do. I like
No,
Descartes
14
an
not bad.
awful lot. Yeah.
Yeah, some of these are going to be a little bit tough. I don't know if we can keep Simpson on the list at 11% here and over 2 billion. So that one's going to be kind of on a hot seat. We did talk fairly extensively about Western Alliance. I think that's a candidate to make it, especially
Yeah,
if we're at 16 companies.
Globant's getting a little bit large also, Mark.
A little bit, but that's a recent roundtable selection by you, right?
Yep.
Yeah.
Uh-huh. Yeah.
All right. So some interesting stuff here. I did go ahead and add, just so we've got them for comparison purposes, the percent from the 52-week low. Again, Hugh McManus champions trying to find stuff that's within 20% of its 52-week low. And there's a number of candidates on here. And again, maybe a tie-breaking criteria in addition to the RSI. And I'll tell you, Ken, the thing that really struck a nerve with me last week while you were out looking at the colored leaves is look at that relative return column for these companies. And you look at the amount of general market outperformance. And some of these are over fairly long time frames, because this column here is basically dating back to their IPO or their inception. There's actually a couple of companies on here that predate 1993, so they're not exactly new and small. But you take a look at that amount of outperformance over that period of time. I don't know. It kind of gives me chills. And
Yeah, I've really wanted a way to include Stavanto in our list, but I just don't think it's going to be able to make it with some of the numbers. It's quite if you haven't taken a look at it, folks, take a look at what it does and the kind of market that it's appealing to. It's really a very interesting, it's an Italian company, foreign, ADRs in the US, of course, but take a look at it. Look at its relative return over. It's an old company, so that's not a number that should be taken lightly.
yeah, and just to nutshell it, they make the delivery devices for many of the drugs being put out by, well,
The
40.
large the large molecule drugs like insulin and Ozempic, Mounjaro, that kind of thing.
So it's probably the bandwagon is certainly out of the barn, if I can mix my metaphors a little bit on that one. The other one that really grabbed me was Dreamfinders Homes. I'd never heard of the company, Ken, and many people have.
I haven't either. What's that? My goodness, look at the sales on that company.
Yeah, and that's where it gets blown out. It's kind of like Green Brick as far as the type of company, but pretty good numbers, pretty good. They're a little bit more of an eastern seaboard slant and going a little bit further north, but they have Dallas and Florida covered, Georgia, and then going up north. And same type of company with a little bit different approach, but I don't think we can get them onto our list at at those levels. But
yeah, I'd like to get people talking about Neogen again. If you've never taken a look at this company because you thought it was overvalued, or and it was at one point extremely overvalued, you might want to take another look at Neogen right now. It recently completed an acquisition of 3M's food safety unit and practically doubled its size in the process. read the fourth quarter earnings report. There's a PowerPoint presentation that they did for the fourth quarter that you might find extremely interesting. It's in the main value line, but right now, because of the merger, its numbers have been suspended. Its projection numbers. The only number you're getting for Neogen right now is a safety number. But it's still worth reading the analysis in the report. A new value line for this company will be coming out within the next week and a half, 2 weeks. So if this is a company that we talked a great deal about 12, 15 years ago, and then it didn't lose its way, but it became a darling of a lot of people and became extremely overvalued. And now I don't think it's that way anymore. I think a lot of people don't understand what's going on with this merger. And I think it might be a very opportune time to buy a $15 stock and watch it go back to $60 or $70.
Yeah, and I think it's also going to be a nice case study showing there's going to definitely be a delineation between the old company and the new company when you do your analysis.
Absolutely. The projection
list.
for margins with the new company are really quite impressive compared to the margins that were there for Neogen itself. So like I said, the company practically doubled with this acquisition. They took on some debt to make it happen, but the debt is still less than 20% of their capital. So it's an intriguing story, if nothing else, and it's a stock that has a low cost attached to it. So those of you that like to dabble a little bit, you can afford to buy 100 or 200 shares and set it in the back room and see what it does, without putting a lot of money at risk.
Okay, and again, as we have been doing, and many of the companies on this list came from the audience, so that they've come from you. I would just note that in order to make it onto our final list, it does look like you're going to have a quality rating, probably at least 80-ish, if not north of 80. Keep in mind that we are looking for companies probably at 12% and above. So to approach the north end of this short list, those conditions are probably going to have to be a prerequisite at this point. And Ken and I will be going through and making sure that the updates all add up. By the way, a company that showed up in a screen this afternoon, Malibu Boats, Ken. That's on this year's list and been a little bit hammered, but it actually shows up as probably making it in to our top finalist list.
Still own Malibu Boats personally and in a couple clubs.
Mm-hmm. All right, so there we go. Here's a quick update on the Steel Cage Challenge. So far, I'm the only one brave enough to short a stock and go long on a second stock. But the short of Jabil has actually worked out pretty well. In a market like this, the shorts can work out. So the $100 that we received, we would only have to pay back $89.30 to actually buy it back. And InMode has continued to slump with the activities going on in the Mideast, but it nets out to be actually fairly decent exercise so far for me. So we'll come back and do a little bit more with that.
I think, Mark, I just want to say one thing about InMode, and that's when you look at its location, central offices in Israel, please be aware of how many offices it has throughout the world and how many places it has throughout the world where it's conducting business. It is not conducting 100% of its business through Israel.
In fact, it's 1% in Israel.
Okay. You're right. Absolutely.
1% of revenues.
Uh-huh.
All right. So we're going to leave. This is just kind of a tease. I've received numerous questions about this topic. We've covered it a little bit in the past. Thought it might be a time for a refresher. And this is basically paraphrasing some correspondence received from an investment club or two. And they're looking at the most active list, and they're seeing some interesting names. It even gets more questioning if you throw in the companies that are just below this list, the bubbling below or whatever they call it. And just wondering, how these companies with either without earnings or outrageous PE ratios can make it into the field of companies on the most active list. And it's just something, what are your thoughts on this? And see what you think. And Ken and I will come back to this at a future session. What's your knee-jerk reaction, Ken? Other than your Tom Lee speech.
My knee-jerk reaction is that we don't know whether clubs are adding an extra 15 shares to a holding they already have, or selling when it says selling 15 shares out of 500, or selling 50 shares out of 1,000, something like that. We don't have the granularity in these numbers. These are pretty raw numbers, and we also don't know what the portfolios look like as a whole. So to make a lot of conclusions out of the buys and sells when the numbers themselves are small to start with, I think is really dangerous to do, and especially when we know that a lot of these Magnificent Seven stocks anchor an awful lot of portfolios. And when you think you might have a buy, then you tend sometimes to add a few more stocks. I know that we've added to Visa in my primary club a number of times in the last 7 or 8 months. We don't generate a lot of capital every single time, every single month, but we'd rather have that capital sitting in a stock as kind of a holding place, especially when the SSG tells you that it might have a potential return in the low teens. And for these large companies that we're looking at, the list is practically all large companies. From these large companies, when you can find something with a return of 11, 12, 13% potentially, that's not a bad investment in my mind. The same thing with AMD, the same thing with Alphabet, and occasionally with NVIDIA. I remember Manifest Investing showing me NVIDIA with a return in the sweet spot just recently.
Mm-hmm.
So I just don't think that you can draw a whole lot of conclusions about what's going on with club portfolios by looking at a list like this.
Okay, I would generally agree with that, and just admit that Microsoft is my top holding by percent of total assets.
Microsoft is my top holding as well.
And it's also true for the round table. So we'll come back to the subject and try to dig into it a little bit deeper, bringing things like the top 100 to bear, maybe a couple of other things we can look at. But interesting
so
topic.
If Microsoft goes bust, we're all living together then, Mark? Is that it?
No, if Ardelyx goes bust, we're living together.
Okay.
And Portillo's.
And Portillo's, of
I still
course.
don't have that. All right, just stuff that's coming at us. Some more stuff on early stage investing, and then I just love that graphic from Brian Feraldi on the lower right. The difference between damaged stocks and damaged stock prices and companies. So we'll be talking about that in greater detail. Also, here's a reminder that we do archive all of these sessions, including the roundtables, on YouTube. Just search Manifest Investing Roundtable or whatever, and you'll find it. And there's some good ones there. And we're actually going to close with an autumnal picture. It was interesting. I was sitting with my 3-year-old grandson. He had just sat down on my lap, and we were talking about mesas. And I actually asked the question out loud, and this is a little bit scary maybe. I said, gee, maybe we should find a picture of a mesa. So I turn on my computer, and this picture is the first thing that pops up from David Smith in Colorado, Ken. So Logie and I sat and said, whoa, that's nice.
I want
Nice,
to
and you know the person who took the picture.
Yeah.
I want to put in a plug, Mark, on November 8th at 8 o'clock in the evening. Our chapter is going to be doing our annual Stock Watchers program. We're going to be talking about our contest that ends on the 31st of October. And we're going to be doing a class after that. And I think that the topic of the class is going to be something along the lines of dips and dabs. A little bit of this, a little bit of that, and maybe you'll find some things you're extremely interested in and you can ask some questions about. We'll try to keep it to an hour, hour and 10 minutes total. And it's always a fun time. I'm surprised, Mark, that our enrollment is already approaching 200,
Wow.
and we're still a couple of weeks away. So
Nice.
we'd love for you folks to register for that. If Mark doesn't have a link up, Natalie will make sure to send Mark a link to put up on Manifest. And there's also a link on the Mid-Michigan chapter on the Better Investing website.
It'll be there by tomorrow, sir.
Great.
All right. So with that, we'll just go ahead and leave it unless anything else in the hopper.
No, I have a hand in the air, and I'm going to unmute him at our own risk. It's our friend from Maryland here. So, okay,
He's
Kevin,
harmless.
go ahead. Go ahead. Say what you need to say.
If you go back to slide 20, where you had the most active and the Magnificent Seven.
Okay.
And what I found was kind of interesting is that 6 of the 7 were in the most active, and the one that wasn't was Meta. And that's right after NVIDIA is the one that has had the year-to-date the best return. And, you know, I still own it personally, but one of my clubs got rid of it when it sort of dropped about a year, you know, maybe a little bit more than a year that we got rid of it. And it was just like, I thought that we should have hung on to it, but, you know, you get outvoted, or, you know, the sentiment is to move away from it. No, I mean, it's kind of interesting that the one that we pulled away from is up 147% over the year. So
Even the best club, Kevin, forgets that we have a 5-year time horizon sometimes.
I get a lot of people this time of year that are, one thing we actually are pretty good is we like to be able to balance out stuff for tax purposes. And so we get rid of some things that maybe long-term we should hang on to, but they want to capture the tax loss.
Yeah, and do you always have the debate about we're going to buy it later, and they never do then?
Yeah, that's this time we did it on one of my clubs, and I said, okay, let's make sure we don't spend it right away. You know, let's just keep it there. If we're going to do it, let's come back to it. But
Yeah.
we'll see.
I'll tell you, I've probably told this story before, but I used to hang out with a bunch of the rhinos down in Chicago in the trenches, and we'd be out at lunch, and they would be literally sitting there fidgeting and sweating. And I said, "What's wrong?" He says, "Well, I sold my Microsoft before lunch, and I've got to hold it. I've got to actually be out of it for the next 31 days before we can actually go back. And I have to sit here and hope that it doesn't take off on me." And these guys would sit around at lunch and they would be in agony. And I mean, I would just sit there and smile and say, well, you know, why put yourself through that? And there are times, but you want to be very selective about them. So yeah, wild stuff.
Yeah.
All right,
Mark, other than that, I think we're all up to date. I've answered a lot of the questions, and I think I had one question here. Hold on a second. Let me make sure I get it open. No, we're all set, I think, Mark. Okay.
All right. So
All
Ken, I have to go take care of something on this end. But I'll get back together with you shortly on preps for New Orleans.
Okay, I'm going to be gone for the next hour, hour and a half as well, Mark. Okay.
Okay.
All right. Talk to everybody later.
Take care, everybody.
Thank you for coming. We appreciate your audience.
Thanks, Kim.